Howdy and welcome back. It's SteveDepoe with the Rose Realty Team. Glad you made it this far. This is now the 6th video or vlog in our series for first-time home buyers. I'm glad you made it this far. This is what we've all been looking for. Let's get going. Coming at you today is an interview with one of our great lenders discussing first-time home buyer programs in Texas. We've already covered first steps for first-time home buyers, how much can you afford, finding a home, and the home buying process. Let's go. First-time home buyers, part 5, first-time home buyer programs. First-time home buyer programs. As promised in our original vlog, we have asked one of our partner lenders to explain the first-time home buyers programs that are available in the great state of Texas, or what I like to call the GSOT. Introduction. Now I'd like to turn over this part of the vlog over to TheRoseTeam, an amazing agent and one of our good friends and superior lenders, Philip Art of Moving Mortgage. Rose, it's all yours.
Thanks, Steve. And now I'd like to introduce you to Philip Art. He is the branch manager and senior loan officer at Movement Mortgage here in Flower Mound, Texas. Also, he is in the top 1% of all loan originators in the United States. Our team started working with Philip about 3 or 4 years ago, and Philip has helped us help our buyers get into homes efficiently, effectively, and in good timing. So, welcome, Philip.
I appreciate it, Rose. Great to be talking to you today. You asked me today to talk a little bit about first-time home buyer programs out there and maybe dispel some of the myths out there as well. Mm-hmm. So effectively, when you look at a first-time home buyer, I would say there's really two loan programs out there, FHA or conventional. You know, if you're a veteran, you certainly can buy a home with 0% down. If you live in a rural area, you can do a USDA loan. We can talk about that another day, but that's also a zero down loan program. But generally speaking, most people who are first-time home buyers are either going to go with an FHA, which is a government loan, or a conventional loan. The third, we won't call it a product, but an avenue for clients to get financing is called the Down Payment Assistance Program. Mm-hmm. That is generic to whatever loan program you're looking for, and we'll talk a little bit about that. Okay. First, let's jump into the FHA loans. The characteristics of an FHA loan, it's 3.5% down payment. You can certainly put more down, but 3.5% is the minimum down payment. Very tolerant to low credit scores. We'll go down to a 580 credit score, which is lower than most other lenders. I believe FHA guidelines allow you to go 500 or 520. I don't know of any lender that actually goes that low, but your down payment assistance is going to be much higher if you go down that path. The third characteristic of an FHA loan, it allows for a higher debt to income ratio. And it'll go up to as much as 56.99%. So
would you explain what a debt-to-income ratio is?
Sure. On debt-to-income ratio, there's really two ratios. One is what they call the front-end ratio, and the second is the back-end ratio. Your front-end ratio is basically taking your what's going to be your housing cost, mm-hmm. Or your monthly mortgage payment with your homeowner's insurance and your property taxes and HOA dues, and you divide it by your monthly income. And that's going to be your front-end ratio. Okay. Typically, 43% works really well. Most loan programs don't really focus a lot on front-end ratio. The back-end ratio is typically the key ratio as it relates to FHA loans, conventional loans. The back-end ratio takes your housing expense plus all of your monthly liabilities, not your utility bills or things of that nature, but your car payments, your student loans, credit card debt. Add those together, again, divide that by your monthly income to get your ratio. If your ratios are too high, we can typically provide some advice of how to basically pay off some debt so to get your ratios in line, mm-hmm. so that you can qualify. But again, FHA will go to 56.99% debt to income ratio. Okay. The disadvantage of an FHA loan is going to be the mortgage insurance. All loans, unless you put 20% down, are going to have monthly mortgage insurance. The monthly mortgage insurance, which a lot of people ask what that is there to protect the lender or the investor from default, right? So the only way to get away from monthly mortgage insurance is a conventional loan putting 20% down.
I see.
So the disadvantage on the FHA, it's going to continue for the life of the loan. That change took place a number of years ago, where it used to end, and FHA said no, it's going to continue for the life of the loan. Typically, with 3.5% down, it's 0.85% on an annualized basis. For borrowers who actually have good credit scores, Fannie Mae and Freddie Mac are basically the two engines, if you will, that drive conventional loans. They introduced Home Ready and Home Possible. They also have Home One and Fannie Mae 97%. Let's not get confused on all the terminology. They are designed for putting just 3% down. Some have income limitations, some don't. Part of it's driven by geographical areas and so forth. But 3% down on a conventional loan. And the other advantage of the conventional loan is the mortgage insurance will stop once you reach a loan to value of 80%.
Oh, okay.
The mortgage insurance also is directly tied to what your credit scores are. So the higher the credit scores, the lower the monthly mortgage insurance. And the other driver of mortgage insurance is how much money you're putting down. Typically, you'll see differences between 3% down, 5%, 10%, and 15% down. The disadvantage of the conventional loans, although they'll go to a 620 credit score, generally the benchmark that most of us will use is about a 680 credit score would make the most sense versus doing FHA. There are extenuating circumstances in the event that there's a husband and wife. One of them have poor credit scores or lots of debt. We would exclude them in a conventional loan, so we would go down that path, even though the credit score is lower. It lets them get into a house where they might not be able to do that with an FHA loan.
I see.
The other disadvantage, if you will, of the conventional loan is going to be a lower debt-to-income ratio. They're going to limit us at a 50% debt-to-income ratio. In many cases, it may even get limited at 45%. We all use the same algorithms called automatic underwriting systems. Two technical, one's called DU, the other one's called loan LP we use. So, for borrowers who actually don't have the necessary funds, there's lots of perceptions in the industry that borrowers need to have 20% to do a conventional loan. Not true. Again, as we talked about, 3% down is a minimal on a conventional loan. There are down payment assistance programs out there. We typically drift to using TSHAC, Texas State Affordable Housing Corporation. They have forgivable grants anywhere from 3% to 5%. They also have second liens. The second lien would have to be repaid. Gets repaid either when you refinance the home or when you sell the home.
Okay.
The second lien grants are from 3%, and they just introduced up to a 6% second lien grant. The other advantage of a down payment assistance program is you're going to have lower cost mortgage insurance than you would normally have.
Oh, okay.
And the other great advantage is the down payment assistance programs are available on any loan program, be it FHA, VA, USDA, or a conventional loan.
Oh, okay.
So
that's
it's really
awesome.
good. The disadvantage, which shocks some of the borrowers out there, are the interest rates. The interest rates are going to be significantly higher. Today, FHA loans are in the 4%. The conventional loans are in the 4% range as well, where these down payment assistance programs could be as high as 6%.
I see.
So the money is available, but it's costly.
Sure. So you're actually rolling in the down payment into the loan, and that's why it costs more?
No, it's a concept called premium pricing.
I see.
So effectively what the investors are doing, and we don't control the interest rates. These are controlled by TSHAC, and they're an investor behind that. Effectively, they're doing what we call premium pricing, which is raising the interest rate and using those funds for the down payment assistance.
I see.
We do something like that in helping borrowers with some closing costs. Instead of giving them the lowest possible interest rate, we would increase the interest rate and we would give them back that money as part of to be used for their closing costs.
I see.
It can't be used for the down payment.
I see. Okay. Well, that must add some significant time then to get a loan by doing these programs.
Not really. We typically close loans, as you know. One of our competitive advantages is closing loans as fast as 10 to 15 days. Actually, last year I closed 3 loans in 8 days, which is the fastest legally allowable.
Wow.
When we add in a down payment assistance, it generally delays the process by a couple of days.
Oh.
So we can certainly close down payment assistance loans in 15 days easily.
Wow. Well, that's really terrific.
Yeah, certainly in today's multi-offer marketplace,
Yeah.
as we try to segment what's to get an offer accepted over others.
That's right.
The fact that our clients are underwritten approved in advance prior to making an offer, and the fact that we can close in 10, 15 days has proven to be a competitive advantage in getting offers accepted.
Actually, I think about it, someone walks in with cash, and I don't know if everyone is aware of what statistics are, but typically people who walk in with cash are more likely, I think 75% more likely to walk away from deals, which should, if I was a seller, would concern me. Whereas if you just wait 10 days or 15 days for a loan where people they've got some buy-in and skin in the game and are extremely much more reliable in terms of completing the deal, that's the conversation that I will have and that Philip will have with the seller's agent in multiple offer situations.
Yep,
And
absolutely.
we've done that before. So, well, thanks, Philip. I think that was really very helpful, very informative.
Appreciate the opportunity to talk to you and your clients. Thanks a lot.
Thanks.
Thank you, Philip, and thank you, Rose. That concludes our first vlog series for first-time homebuyers. I hope you found it as informative and instructive as we found it fun to make. That concludes our vlog series for first-time homebuyers. We covered first steps for first-time homebuyers, how much home can you afford, finding a home, the home buying process, and we just concluded an interview with one of our great lenders discussing first-time homebuyer programs in Texas. To connect with Philip Art, a special guest from Movement Mortgage, call him in the office, 972-468-0005, or call his cell or text at 214-676-2402. Philip's email address is philip.art with 2 T's at movement.com. His website is www.movement.com/philip.art. This series of vlogs was brought to you by the Rose Realty Team. Call or text us at 817-368-6522 or email us at TheRoseTeam@kw.com. And those are our websites. If you're interested in advance notice of our next vlog series, you can call, text, or email us, and we'd be happy to include you in an advance notice list. Call or text us at 817-368-6522 or email us at TheRoseTeam@kw.com, or just watch for our next installment. Again, I was happy to present this video series to you. This is Steve DePoe for the Rose Realty Team. I'm going to bounce.